Hey guys, Whitney here. Welcome to the Passive Investing Made Simple show. I'm your host, Whitney Elkins-Hutten, Director of Investor Education here at passiveinvesting.com. And this is the show that we do every Tuesday to help you learn the ins and outs of passive investing so you can go into your first or next deal with confidence. And if you haven't already, be sure to check out passiveinvestingwithwhitney.com. There you get access to my free ebook, Passive Investing Made Simple, as well as you can access my calendar if you'd like to talk about passive investing, the power of passive investing, and also see our open deals. And again, be sure to check out passiveinvestingwithwhitney.com. All right, guys, I'm going to give it a couple more seconds. We got people filing into the Zoom room. But today we are going to dive into the lazy 1031 exchange. Now, this comment is kind of a tongue-in-cheek comment, right? It's not a 1031, nor are you being lazy, but it is a way to utilize one of the biggest perks of real estate, biggest advantages, I should say, which is depreciation, in order to move assets and keep them tax-free and keep from, or to offset capital gains and depreciation recapture. Now, guys, none of what we go over today is financial advice, okay? So if you are interested in this strategy, you have to partner with your accountant to make sure this strategy actually will work for you in your investing situation. All right, so what we're going to tackle today is we're going to learn one of the biggest myths that keep passive investors sidelined. We're going to learn the different terms that go into lazy 1031 exchange so you can avoid making a costly mistake. And then we're just going to help you put this knowledge into use with examples. Now, if you haven't ever joined one of today's shows, again, my name is Whitney Elkins-Hutten. This is the whole reason why I invest in real estate, is me and my crazy crew here. Essentially, I started off as a real estate investor in 2002. I bought a house with a significant other. And then about a month later, the relationship fell apart and I got the house. Long story short, I was able to rehab that house, sold it 11 months later, and I was hooked by real estate because I made more money in that 11 months doing a side hustle after my day job, having me travel about 80 hours a week, than I did in my actual day job where I was spending all that time. And so I was hooked by real estate and did several more of those live-in flips, house hacks on my own, and then together with my husband. And then eventually we transitioned to buy and hold real estate. And from there, we transitioned into larger private equity deals, both for me, on the syndication side, and then also passively together. And what we've been able to piece together through our many years of investing is this is our personal portfolio, 6,500 multifamily units, 2,200 self-storage units, 7 car washes, myriad of other passive investments. But really what people resonate and what you probably resonate with is that we have 100% control and choice on how we spend our time. So maybe you're here because you want to achieve one of those 5 freedoms in life. You want financial freedom, time freedom, choice freedom, freedom of location, or freedom to go out and create an impact on the world. And that is what we can help you do here at passiveinvesting.com. These are just a few of our powerful metrics we've been able to deliver to our investors, over the course of the past several years. And like I mentioned before, at the top of the presentation, we're going to be diving into 1031 exchanges, but none of which what we cover today, it should be construed as financial advice, legal advice, or tax advice. So if you're interested in this, these are very viable strategies. You need to put together a team to make sure that this strategy actually applies for your situation. All right, so what exactly is a lazy 1031 exchange? Okay, why are we even talking about this? And it's because one of the biggest myths that investors have, it's actually the second biggest myth. The first myth is that investors think that they don't have any control when they invest passively, and that's simply not true. I show you in all of our boot camps how you as an investor can maintain control in any passive investment you go into. Now, it doesn't mean all passive investments you get to maintain control, but if you're following the outline, the framework that I give to you, you can maintain an immense amount of control in passive investing. Okay. Not as much as if you held your own control real estate. And the reason being is that you're outsourcing operations to that expert in order to get your time back. Now, the second biggest myth, what you see here on the screen, is that investors think I just won't make that high of a return. It's like, unless I do it myself, there's just no way I can make that higher return. And that's simply not true. Okay. We dive into all the details on how to underwrite a deal, to align with your goals for cash flow and equity growth. How do we evaluate that? But what we're talking about here today is how you can impact your return by continuing to either leverage 1031 exchanges, but more importantly, if you're not interested in doing a 1031 exchange, how can you leverage what we call the lazy 1031 exchange to continue to amplify your returns in passive real estate? Now, we have to start off our conversation with what is a 1031 exchange. Before we can talk about a lazy one, what is the actual 1031 exchange? Well, this law came into being in 1921 after the first tax code was published. And essentially, this law stated the 1031 exchange, that's the number in the IRS tax code, okay? It allows for like kind real estate asset exchange to defer capital gains and depreciation recapture, all right? Now, before or in 1921, the law actually allowed you to exchange real estate for business or business for real estate. It allowed you to go back and forth. And then in 1924, the IRS got smart and went, whoa, 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 we're losing out here. So it has to be like kind, real estate for real estate, business for business. All right. So why do we want to actually understand how to do a like kind exchange? And it's because the tax code is actually kind of like a treasure map. If you guys follow Tom Wheelwright's book, Tax-Free Wealth, he loves to explain that the IRS tax code is essentially a treasure map where the IRS is incentivizing people, us, on where to put our money in order to solve problems, okay? In this case, they want us to solve real estate problems and business problems. Those are the two things that the government really has no interest in figuring out how to house everybody, nor how to figure out how to provide, for everybody. Okay, so we as the investor get to do that. Okay, and because of that, because since they want our money as investors solving housing problems and business problems, real estate problems, they want our capital to continue working hard for us with no downtime. And that's why in the tax code, they gave us the 1031 exchange, meaning that we can do that like kind exchange with parameters, right? There's a lot of rules to continue trading up our assets. Okay, otherwise what would happen? An investor would go in, make all their money off of a particular real estate development, and then they'd pull off right off into the sunset and take their capital with them. No, they want us keeping our capital in and making money, in perpetuity. All right. Oh, somebody asked, can I repeat the book title? Tax-Free Wealth by Tom Wheelwright. All right. So what does a 1031 exchange actually look like? Okay. So let's say you own your own real estate rental, or maybe you have a small multifamily. Okay. This is not your primary house. That's a totally different tax law there. That's called a 121 exclusion. But here we're talking about your own investment property. Essentially, in order to perform an exchange, you would, and this is what you would do with us, is that you would sell your asset, okay? And, if we're doing this passively, all the investors in that asset would get notified. And at that point in time, when you're notified of the 1031 exchange, okay, or maybe you have a group of investors in your own deal, those investors have to make a decision. Do I want to stay in the asset or do I want to leave? Okay. So now at this point in time, no clocks have started because you haven't closed on the sale of the asset. All right. But for us, if you decide to stay into the 1031 exchange, we take care of everything. We're going to go out and find another asset, and then we're going to also help, source new debt and investor capital to close on that asset. But if you're doing it yourself, you have to do that. If you decide you're going to put an asset into a 1031 exchange, you have to make the decision before you close on that sale. you have to contact what we call a qualified intermediary. And then once you hire the qualified intermediary, they're going to be inserting themselves in the closing process. You can't touch the money, but you can go start shopping for other assets. And you have 45 days post-close to identify up to 3 assets, and then 180 days to close. Now, there's a ton of other rules in there that you got to play by, but this is where a lot of investors go, I don't want to do this. This sounds complicated. I don't have time, or, I just don't know where to go find another asset. Like, normally the time that's best to perform a 1031 exchange, it's when asset prices are high. But also, guess what? If you're trying to buy another asset, that asset price is going to be high too. All right, but this is what one looks like when we are doing a 1031 exchange inside of a passive asset. Okay, now we've talked about what a 1031 exchange is. Where did the law come from? A little bit of history about the law. What does one look like if you're actually a passive investor? We talked a little bit about what one looks like if you're trying to perform with your own controlled real estate. Now, sometimes it just doesn't make sense to do a 1031 exchange. So what is the case against doing a 1031 exchange? Well, like I already mentioned, the time, usually when you're selling high, you're also going to be buying high. Okay, think about it. In 2021 into the first part of 2022, asset prices were soaring, and you probably had to overpay if you were going to go into a 1031 exchange. All right. There's a ton of pressure. There's a schedule that you have to follow to find a replacement asset. And sometimes there's so much immense pressure, you feel the pressure to identify a replacement asset that it actually isn't that high quality of one, depending on what the market's giving you, right? In order to do 1031, you actually have to spend up, okay? It's not like you can take, spend down, right? In order to get, assets paid off all in cash. No, you actually have to trade up. So you can't consolidate that all cash position. You can't move asset classes, all right? We can't go from real estate to business and business to real estate. Now, we can go multifamily to self-storage to multifamily. We can do things like that. We can go single family homes to multifamily to self-storage, right? We can move around within real estate, but we can't cross those two asset classes. The other thing that we can't do, at least very easily, and hence the reason why we're going to talk about the lazy 1031 exchange. But according to a 1031 exchange, you cannot move from actively controlled real estate. So if you have that single family or small multifamily in your portfolio now, you can't move it to passive investments, okay? Single family to syndications. That's something that you cannot do a 1031 exchange. Now, I'm going to give you a workaround, okay, here in a second. So this is the case. Like if you're wanting to, having some technical difficulties here, guys. Let me get back on track. If you're wanting to do any one of those things, okay, to reorganize your portfolio, it can be a little bit hard, right? So what are alternatives available to you? Well, say you're like, I am done with my single family rentals. That was me. And you're like, I want to move it all into larger institutional grade assets. There's a couple of different options. I can't directly do a 1031 exchange from my single families into a syndication, but I could do a 1031 exchange into what we call a tenant in common relationship. And that tenant in common relationship could then potentially be on the general partnership side of a passive deal. Now, we do help our investors do that, but it takes a lot of legal and proceedings in order to get something like that done. So generally, we look to source we'll look for that 1031 exchange or the tenant in common to be at $1 million in multifamily or going into a multifamily deal, or $500,000 and above on a self-storage deal. Now, just like, remember, we now have figured out a way to get from actively controlled real estate into a passive deal, but it's still a tenant in common 1031 exchange. So you're still bound by all those timelines. So I encourage you, if that is something that's interesting to you and you're looking for that type of deal now, reach out to me at whitney@passiveinvesting.com and let's have a conversation. Because again, we have to abide by all those timelines in order to get an asset identified for you. And so it's not something that a deal opens up and we can like scramble you into it like within a week or so. There's a lot of paperwork that needs to be done. Another alternative, if you're going to forego like a traditional 1031 exchange where you're trading up your own asset, is you could potentially invest in an opportunity zone. Now, I am not an opportunity zone guru. Normally, this is where I get a ton of like questions in opportunity zones. What I can tell you about opportunity zones is that there's a lot of parts of the law that are still pending for interpretation, and it's been largely untested. But this could be a viable option for an investor if you've got millions of dollars coming out of a potential real estate deal. All right. Another option on the table is what we call a deferred sales trust. And I look at these as like a private investment. And again, majority of these deferred sales trusts, if you're setting up your own deferred sales trust, they really don't make sense unless you have $1 million in equity or more. Okay. And then you got the ongoing fees associated with setting up the deferred sales trust. Another option is a DST. Now, DSTs kind of look like and smell like a syndication, and they kind of are at the end of the day, but you're probably going to find a DST with a banker. And but these DSTs tend to be pretty low cash flow. And oftentimes what I hear from investors, they're just not the right type of deal that they want to move into. They're probably lower cash flow positions and higher equity positions. All right, so what is the other option that you have available to you if you want to continue to defer your capital gains or offset your capital gains, offset your depreciation and recapture from the sale of an investment asset, but you don't want to do any one of these things? Either you don't meet the parameters or you just don't want to, pursue that avenue. And I got one more opportunity for you, and that is the lazy 1031 exchange. So the advantages of doing what we call the lazy 1031 exchange is that you can actually avoid the pressure of having to buy at a high asset price. Okay. It'll allow you to move from active to passive. So you could essentially like sell your active real estate, take possession of all that money, okay, and now get that all invested into a passive deal. Okay, so essentially you can move the portfolio. Thereby, it actually potentially allows you for greater diversification of your portfolio. Okay, maybe you were super concentrated in one market and single family homes in one market. For me, I was highly concentrated in single family and small multifamily in Kansas City and Indianapolis. This now, going through this process multiple times, it has allowed me to diversify my portfolio over multifamily, self-storage, car washes, as well as geographical markets. So I'm not so exposed to any one particular market. It can allow you to consume part of your gain. So a lot of times, us as investors, we sell a asset and we're like, man, we just want to go buy that new car or take that cool vacation. I mean, we worked hard on this asset. Let me take a little bit of the capital and enjoy it. Okay. If you're doing a 1031 exchange, you can't do that. Okay. If you're doing a lazy 1031 exchange, you could do that if you chose to. All right. Another advantage is that you could move that money from active to passive, but look for an operator that does 1031 exchanges as their investment strategy, like what we do here at passiveinvesting.com. We've done 8 to date. We've done over 8 exits all through 1031 exchanges. So now you're moving your money, you're taking advantage, right? You're stepping up in basis, you're offsetting a large part of your capital gains and depreciation and recapture. And now you're going to have this magical bucket of losses start to build up. And if you're going to, with an operator that love and trust that's going to do 1031 exchanges, you can ride the ride that way. Craft your investment portfolio that way. Now, one of the disadvantages, full transparency, of a lazy 1031 exchange is that it may not actually offset all of your capital gains and depreciation recapture. That is a very real possibility. And But even just think about like, and these are just rough numbers. Let's say you sell a property and you were going to have $100,000 gain. But you could go into a passive deal and offset 70 to 90% of that. Okay. Now, instead of being taxed on that full 100,000, now you're going to be taxed on a much smaller portion. So we significantly, exponentially reduced your tax bill. Okay. And it's not just dollar offset, it can be a significant reduction. All right. So how do you execute one? All right, we talked about a large part of what it is, okay, the advantages and disadvantages, but how do we actually do this? Well, it's pretty simple, okay? But I'm going to give you a couple pointers here in order to do this most effectively. First thing you have to do is sell an asset. Now, I encourage an investor, all of my investors, to sit down, maybe the end of the year, look at, this is the moves I would look at to do in like November through February, but we're not too late now in May, certainly not too late. But in the slower time of year, maybe look at your portfolio November to December. If you've got a piece of investment property that you're like, this is underperforming, or maybe I've topped out in this market, or I just want to get out of it, look to get it in position to sell in the spring market, February, March, April, May. Okay, so try to sell as early in the year as possible. All right, now what you're going to do is you're going to take possession of all those gains and liquidate that equity. You're going to take possession of all of it. Then you're going to reinvest all that capital as much as you possibly can, ideally with the down payment that you had, original down payment you had in that property, into a new asset. Okay. And you've given yourself time to look for a favorable asset that has accelerated depreciation and bonus depreciation. Now, this is still a very powerful strategy right now because our bonus depreciation in 2024 or 2023 is at 80%. So we can still maximize a good portion of the depreciative losses, the accelerated depreciation on these assets to get you a nice year one depreciation offset. Now, again, remember, this isn't going to be more than likely going into passive deal. It's not going to completely wipe out your entire gains and recapture, but it can give you a nice advantage to help you step up your basis in the asset, move from an area of controlled real estate into passive real estate, allow you to diversify your portfolio across not only types of assets, but also geographical areas.